Good morning, everyone. Welcome you all on the webinar on financial viability and project structuring under PPP model. I am Kuldeep Chaudhary, Program Officer, CITIIS 2.0. I welcome all of you on behalf of CITIIS team. And today's webinar will be bridging the gap for making projects bankable. And we have esteemed speaker with us, Jailendra. And I hope that discussion will be give you insight how to make projects bankable in MSW waste management. I will invite Ankur Yadav. He is a program manager with CITIIS team, and he will give you the context setting of the webinar. Over to you.
Thank you, Kuldeep, and a very good morning to everyone, and a very warm welcome to today's webinar, which is on a very important topic, financial viability and project structuring under PPP, public-private partnership. Myself, Ankur Yadav, circular economy specialist and program manager under CITIIS 2.0, and it is my pleasure to welcome you all to this particular session. Before we begin, let me briefly introduce you to the CITIIS 2.0 program under which this webinar is being organized. So just to make a full form to the abbreviation, it is City Investments to Innovate, Integrate and Sustain. This is a flagship urban development program of the Ministry of Housing and Urban Affairs, implemented in partnership with the French Development Agency AFD, German Development Bank KfW, the European Union EU, and National Institute of Urban Affairs, which is NIUA. As part of its continued efforts towards capacity building and knowledge dissemination, CITIIS 2.0 is organizing this webinar to discuss this aspect of municipal solid waste management, where financial viability and project structuring under PPP mode is of vital importance. Under CITIIS 2.0 program as well, cities across the country are working towards building integrated, circular and sustainable municipal solid waste management systems. The selected cities are 18 in numbers, and financial viability is also one of the core effort which identifies its viability. So in general, when we look at projects, we should understand that a project may be technically well designed and address a clear need or have a vision, but if it cannot sustain itself financially, it may struggle to deliver its intended environmental and service delivery outcomes over the long period of time. That's why we have to understand that this is not a new challenge. This has been ongoing and faced by the projects over the course of time across the world. Now we have to zoom in it with the today's perspective for waste management. So further, we have also observed that the kind of persistent challenges which are faced by the cities is also related to the financing of the infrastructure which is required for municipal solid waste management. And projects had sometimes struggled not because of the underlying need or technology being inappropriate, but because of inadequate upfront planning, unrealistic cost and revenue assumptions, and weak risk allocation between the authority and the private partner. And this is exactly where today's discussion becomes important, and that's why we are hosting this webinar. So as cities increasingly explore public-private partnerships to bridge funding gaps and bring in operational efficiency, it becomes essential to understand how projects can be structured to be genuinely financially viable, and an important term which we would be hearing is bankable. This means we are going to look carefully at the cost, revenue models such as user and tipping fees, appropriate risk allocation, and instruments such as viability gap funding and credit enhancement. So today's session will bring these aspects all together, and I hope that it provides practical insights which will be useful as you plan and structure municipal solid waste management projects, or in general for the project ideation in your respective cities and the way you are progressing. And we will also take care of the fact that The solid waste management rules of 2026 are already in practice from April, and I'm confident that the discussion will be of great practical value to all of you and through our esteemed speaker. So with that, I will invite Kuldeep to introduce our speaker for today's session and take this discussion forward. So thank you, and over to you, Kuldeep.
Yeah, thank you,Inku. Thank you so much. It is my pleasure to introduce Jailendra sir. So Jailendra sir is domestic expert at CITIIS 2.0 with over 20 years of experience in infrastructure sector. He possesses a comprehensive understanding of infrastructure sectors.
Just a minute. Just a minute, we need to check. Is the echo is still persistent? Is your mic on? Can you check? Okay, okay. Let me switch it to just a minute. Huh? Thank you for updating in the chat. I may reiterate. How about now? Is it better? Okay. Is this fine? All right. All right. Thank you. So
It is still there. So you're saying it is okay now.
if it is fine, then just give me a heads up. Then I will just. It's fine. All right. Thank you. So I think that if there might be an echo and there might be some of the facts which could not be heard properly,
It's fine.
I will just quickly again go back to what I have mentioned quickly. This time I will be brief. So it is really important to acknowledge your patience and also good morning everyone once again and very warm welcome to this webinar. We are looking on the topic of financial viability and project structuring. I am Ankur Yadav, Circular Economy Specialist and Program Manager under CITIIS 2.0, and it is my pleasure to welcome you all to this particular session. Before we begin, we must know that it is being organized under the CITIIS 2.0 program, which is City Investments to Innovate, Integrate, and Sustain, which is a flagship urban development program of the Ministry of Housing and Urban Affairs, implemented in partnership with the French Development Agency AFD, German Development Bank KfW, and European Union along with NIUA. So as part of its continued efforts towards capacity building and knowledge dissemination, we are hosting this webinar to discuss this important aspect, which is related to project structuring and financial viability for municipal solid waste management. We also know that under CITIIS 2.0 as well, 18 cities are working towards building integrated, circular, and sustainable waste management systems. And there itself, financial viability sits at the core of this effort as well. So we must understand that a project may be technically well designed and it addresses a clear need, but if it cannot sustain financially, it may struggle to deliver its intended environmental and service delivery outcomes over the long period of time. And this is not a new challenge. We understand that it has been observed that projects are sometimes struggling not because of the underlying need or technology is inappropriate, but because of inadequate upfront planning, unrealistic cost and revenue assumptions, or maybe with weak risk allocation between the authority and the private partner. So this is why today's discussion becomes very important and very relevant, and that's why to bring these all aspects together and provide some practical insights while you are going to plan structure projects, then you must stay in the webinar till the end to understand, put up your queries. And now I will invite Kuldeep to introduce our speaker for today's session and take this discussion forward. Over to you, Kuldeep. Thank you.
Yeah. Thank you, Ankur, once again. It is my pleasure to introduce Jailendra sir. So Jailendra sir is a domestic expert at CITIIS 2.0. He is with us with over 20 years of experience in infrastructure sector. He possesses a comprehensive understanding of infrastructure sector, including urban development, highways, ports, airports, industrial parks, and tourism. His expertise spans project preparation, techno-commercial feasibility studies, project structuring, procurement, and contract management. Jailendra is currently the director at RBS Infrastructure LLP, an urban consultancy firm. He has previously worked with organizations including INFS, ENY, Boston Consulting Group, ADB, and World Bank. He has also completed his BTech and MTech in Sociology from IIT Madras. With this, I will invite Jailendra sir to present the session. Over to you, sir.
Thank you, Kuldeep and Ankur, for the opening remark and for the introduction. Maybe Ankur or Kuldeep, you can just confirm whether you are able to see my screen once I start sharing.
Okay.
Yes, your screen is visible, sir. Perfect. It's visible. Yes, and full screen.
Okay. So it's in the presentation slide mode. I hope you all can see.
Yes, it's visible.
Okay, great. So a very good morning to everyone. And I would like to thank NIUA for this great opportunity. I think we all, when we are associated with solid waste management, typically we think about only the technical aspect. And somehow, we believe that financial aspect or the project cost estimate, these things can be plugged in once our project report is prepared or once we are through with everything. And that is where we go wrong, especially when we are trying to prepare the project on PPP basis. So it is not a separate department's role to plug in the finance element once all your technical stuff is done. Rather, it should be looked at parallelly when you are preparing the project from the start. And there is something called project development process, especially in the context of PPP. So as we go forward, I'll explain what the project development process is and why it is very important. But as far as this topic is concerned, financial viability and project structuring, for a while we have been discussing internally in the context of CITIIS 2.0, and I think this is the right time to discuss this particular topic because among the 18 cities, many of them, the components have already been approved. They are going ahead for the project preparation phase under the maturation phase, wherein they will have to deal with these topics. And only dealing with the technical matters, the technology aspect may not be sufficient to close the project successfully. So I think this is the right moment to take up this topic. And let me go forward and start the discussion from here. So first of all, why do we need to look at PPP as one of the tool for waste management? So we all know the PPP has been prevalent in many other sectors in India, and in urban sector, although the presence of PPP has been limited, primarily because of the nature of the assignment and the applicability of the user fee in the context of urban sector. There are projects like water, wastewater, where there is hardly any user fee. And in general, structuring a project on PPP doesn't become viable. So solid waste management to some extent has given us an opportunity to at least bring in that private sector on board. There are certain examples that we have been able to set wherein it has been successfully developed by private party and it is being operating in a much better, efficient manner. So solid waste management is one sector where definitely PPP can be explored. Now it is a matter of how well you can structure the project. Most of the time when we think about PPP, it is, people only think about bringing the private sector investment. That's not true actually. And most of the time people get into these definition part. what will fall under PPP, what will not count as a PPP. So only if you look at it from the lens of private investment, that may not hold true. It can be also for the operational efficiency part. So I would request you not to get into these definition and the jargons. And if you simply wants to understand what will be counted as a PPP and what will not, think about having a partnership for any reason. Whether you want investment, whether you want some kind of, improvement in service delivery, whether, you have certain competence, which you don't have certain competence, and that is why you want to bring in a partner. The reason can be many, but as long as you bring in a partner so that you complement each other, that can be called a PPP. So sometimes, we get into the definition and things get stuck there. Although, if you go to the history, there have been cases wherein, the PPP projects will be only wherein the private sector investment is more than, say, 70%, and that is how the concept of VGF has also being brought in. But leave that aside. As far as the definition part is concerned, just imagine that you are partnering with someone, whether for investment, whether for service improvement, it can be called a PPP. Now, as far as solid waste management is concerned, we all are aware that in the whole value chain, the value chain can be categorized in these 4 stages, which is the collection, transportation, processing, and disposal. So from technical point of view or from the operational point of view, the city only looks at these stages, 4 different stages. But if you look at it from the financial viability and the project structuring point of view, these are different cost heads. These 4 stages are having their own risk associated with them. And they will also have a different kind of revenue model or the pricing structure. So it is very important to look at stage wise, what stage plays, how much role in terms of cost or the challenges or the risk or the revenue logic. And each of these stages will have their own cost heads. So for example, collection will have, number of bins, you need vehicles, you need staff. Transportation will have your transfer stations, vehicles, fuel. Processing can have, different cities can have different kind of processing facility. It can be composting, MRF, waste to energy, your CBG, whatever the processing facilities, and then finally the disposal. So if you look at all these 4 components and the total investment envisaged for a given city, the waste to energy project itself will cost approximately 400 to 500 crores. Or even if it is not waste to energy, simple, MRF or composting. The capital investment required for the implementation of such project is huge. And if the project has to be executed in a period of 1 year or 2 years, so accumulating, so much of capital for the ULB becomes extremely challenging, because ULB is not only responsible for solid waste management, they have also other responsibilities also. So fundamentally, there is a funding gap. The municipal corporations, they don't have so much of fund to execute such project in one go. And there exactly PPP can help. You can, the PPP can leverage the private capital. And at the same time, the operational efficiency from the private sector. Although when we talk about PPP, we should not look at it as a magic tool that you just bring in a private partner and everything will be resolved. There are certain things that even if the private sector comes on board, they will not be able to if if you have not done your homework properly. For example, you have no clue what is the what is the total quantity of waste the city is generating, whether you have land available for the, to set up the facility, if you have no idea about the risk associated, whether it can be commercial risk, it can be environmental or social risk. If you have not done these due diligences, and if you simply expect the private party will be able to handle everything, that would not hold true. And that is why it is very important to look at the entire project development process wherein you not only gather all the information data, but also try to mitigate the risk over a period of time. And that is how PPP can help the cities here as far as solid waste management is concerned. In this today's discussion, we are only going to focus on solid waste management and how the financial viability and project structuring. Although, post this session, people can definitely reach out to me for in general applicability of PPP and structuring. One more point I wanted to mention here is that when we say financial viability, okay, people are pretty much aware, but when we say project structuring, this particular term is quite common in the PPP domain. But for the general public, sometimes they get confused. What is this, project structure? And for the benefit of the large audience, I would say this has nothing to do with the, the beam and column and the actual physicals, the structure that we, the related to construction. So this is when we talk about project structure in PPP, this is a basically overall framework on the basis of which your project would stand, whether it is mature enough to invite private party or not. So that is the kind of framework we are talking about. Sometimes people get confused, with the terminology. Okay, fine. Now, why it is very important for us to think in this direction is that there has been a, gradually there has been a shift from the ministry side also, and overall how the government is thinking, from grant-led support to bankability-led support. And now the cities are being asked to not just submit any proposal, but submit proposal that makes sense, financially, especially, project has to be self-sustainable. So how the transition has happened earlier, the previous missions, if you notice, starting from, JNU RM time and then again SBM, the focus was primarily on the asset creation, wherein the funding will be provided by the central ministry under the mission guideline. And there is some kind of formula for the budget allocation depending on the urban population of the state and overall size of the city. And that was the basic criteria how the funding will be provided. But now things are changing. Now the missions are also getting modified. Now they are considering only the project that makes sense financially, that are self-sustainable, where you can leverage private funding, because again government has realized that the government fund is limited. If 100% of the funding has to be made by the government, they can do limited intervention. Whereas if you can leverage private funding, depending on 30-70, 20-80, whatever it can be, then it can be multiplied. And that is how government is thinking of inviting only those proposals that are financially viable. And in terms of innovation of mission, I would say CITIIS 2.0 has been a great mission dedicated for solid waste management. I think it is the first mission wherein the cities were invited to submit innovative proposals, and we have seen how this approach can be very different from a conventional approach. Similarly, I think all of you are aware about Urban Challenge Fund. This new mission by ministry had set a different kind of trend wherein 25% of the funding will be given by the ministry, and it says that at least 50% has to be raised from the market, which is the private sector funding. Remaining 25% can be brought in by the state government. So which means you are almost bringing 50% of the funding from the market, and 50% is going as a government support. One more thing I would like to mention here is that if you look at, say, the previous era, wherein PPP was definitely suggested as one of the tool to be tried under these missions, but it hardly happened. Why it did not work out? Why cities did not could not successfully close PPP assignment under these urban missions. It is because there was not proper alignment between the mission guideline and how the market functions. So, for example, for the PPP project, maximum funding was made available was 30% in terms of VGF. But if you adopt a parallel route, non-PPP route, which is EPC mode, then the funding was made available up to 50%. So you can imagine for any city, there is no motivation for a city to adopt a difficult path of this project development process and try to prepare the project on PPP basis. Rather, they will simply go for EPC mode and avail 50% of grant. So if you look at it from city's point of view, their whole objective is to get maximum funding from the center, right? So they would definitely, rather than 30%, they would want to go for 50%. So this was the mismatch because of which, I think none of the cities were making significant effort towards PPP project. Besides, there are challenges with urban sector project. As I said earlier, there are projects which doesn't give you that kind of return in terms of user fee. So it becomes challenging to structure them on PPP in general. But otherwise also, I think this is the time wherein the central missions have also aligned to make PPP projects successful. So here I would suggest the cities, especially, the cities that are part of CITIIS 2.0, those 18 cities, they have already, crossed one milestone. They have already proved their point that they were innovative in terms of their proposal and when they submitted to CITIIS 2.0. And the next stage for them is to bring in innovation in terms of, financial viability and project structuring. So I would request them to, when they are preparing the project under maturation phase, they can look at it carefully. Now, just to give you an idea where exactly this financial viability and project structuring falls into the place, where exactly it comes, this particular stage. So when we talk about project development process, what you see here from, there are number of steps, almost 8 steps are mentioned here. These are different, component of a project's development process. So how, I'll quickly take you through this. So a project can be, identified, because of the public need or the priority or because strategically it is fitting into the context basis the stakeholder consultation. So that is how a project is conceptualized. In your state or city, you want to develop a project, and that is how you thought of a project. Then next stage comes the appraisal, wherein you start doing the pre-feasibility or the the technical feasibility or the sorry technical feasibility of the project. Here you look at what kind of challenges are there, whether you have the land or not, what kind of technologies are required, what kind of different components are there, the overall broad project costing, the financial viability, what kind of risk are associated. That comes into your appraisal, screening, or you can call it project preparation part. Then comes the project structuring, wherein once you have identified what all risks are there, then possibly you can, I think a couple of people are raising their hand. If it is for the question, I think after the session, we will have enough time for the Q&A. So you can just jot down your question and, we'll invite people to raise their questions. So the third stage is project structuring, wherein once you have identified all the risks, you can allocate them, among the parties who are best suited to handle that particular risk. How the payment mechanism will be done, and then the broad term sheet of the PPP agreement. Then comes the procurement, wherein you go to the market, float your RFP and the draft concession agreement. Concession agreement is a basically detailed contract document under PPP that will govern the entire terms of engagement over a period of 20-25 years of the term. You also go for extensive roadshow marketing, and then you select the preferred bidder. Once the bidder is selected, they go for financial close. There will be time given under a contingent precedence. Approximately 6 months to 8 months time is given, wherein they can do their DPR preparation or the raising the debt from the market, closing their financing agreement, all these activity, and then the construction starts, and then operation, and then after the concession period, after 25 years of operation, they hand back the entire asset in the working condition to the authority. So this is the entire process, which is called project development process. So this is the second and third stage before you go for tendering, which is the most critical part, wherein the financial viability and the project structuring comes. So this is to give you an overall picture of from project concept to the project execution and operation, what kind of steps are involved. And I would suggest it would not be wise to skip a particular step here and simply jump to, say, RFP and say that we will go directly for tendering and we will decide then and there what kind of fee or what kind of quote we can get from the market. That may not be a right approach. And also don't just look at these different steps as an activity that okay, just to tick box, like we have done this, now next step is we have to do this. The whole idea is to, in every step, we are trying to prepare the project well for the private sector developer, to give them enough comfort that the risk have been mitigated, the payment structure is, are decent enough for him to be able to make good return. So it is the preparation part. And sometimes the cities, I have seen so many cases where we get into these nitty-gritties of how detailed my DPR is, or whether we have mentioned this particular chapter in the DPR, how we have done waste quantification. The organic waste in my last survey was 56%. Now it is coming 57%. You see, while doing these kind of exercise, it is fine, but we should never forget the end objective. In PPP project preparation, our end objective is to close the transaction. The only way you will be judged whether you were successful or not is that there is only one parameter. Were you able to close the transaction successfully or not? If you're not able to close your transaction, then regardless of how many documents you have prepared, how detailed your DPR is, it doesn't make any sense. So, and people tend to forget this, and we get into these kind of issues most of the time. So let me give you an example so that you remember this always. You would not want to go to a doctor who has spent a lot of time in the OT, and he comes out and he says that the operation is successful, but the patient is dead. You understand? So the objective here was to save the patient. We are not talking about how detailed your surgery was or how successful your operation was. So always remember this, that for you to be successful, you have to close the transaction. And for most of the PPP project, I would say, you will get to know at your feasibility stage itself how viable your project is. And, the further DPR may not even be required, because DPR is typically prepared by the private party once he is selected under the financial closure step. So it is the block cost estimate, the operational expenses, a fairly detailed assessment of these things, plus the associated risk, will give you a fair idea of how the project viability is. Fine. So this is how the financial viability and project structuring falls. And going to the next step, how a financial viability is basically assessed. In a plain and simple term, there is a cost associated. There is going to be revenue from somewhere, and then obviously your revenue has to be more than the cost. When you talk about cost, there can be, so capex is basically the capital expenditure, which is for the project implementation for initial 1 or 2 years, depending on the project component that you have proposed. Then there are OPEX, which is operational expense that will happen throughout the project operation. Then there are financing charge. You may also have to put certain funds separately, put some reserve, and this has to be, or I would say that the revenue has to be more than all these cost element. And revenue basically in the context of solid waste management, either it could be tipping fee. These are the standard terms. Tipping fee is basically the handling charge, typically measured in terms of per ton charges that the private party charge to the authority, or we call it tariff in the context of waste to energy if you are producing electricity. Then user charge, although in Indian context it is not prevalent. User charge is basically directly collecting the charges from the citizens. This right has been with the authority. The ULB takes care of this. There are cases wherein the private party may be helping the authority to collect that, but it directly, in terms of maintaining the books, it goes into the ULB's account. And then there can be some revenue from the byproduct or sale of recyclables. If that is this is the scenario wherein your income is uh, more than the cost, and keeping that in view, if you are able to pay your debt, if you are and if it is giving you good return on your investment, and not just saying that it will make it a bankable project, because you see somebody can ask, okay, let's increase the tipping fee to a great extent. Naturally, this particular, the income box becomes more than the cost box. But then you will have to also look at the affordability of ULB, to whether they will be able to pay such tipping fee on a regular basis. So paying the capex for the project execution is one thing, but paying on a regular basis throughout 15-20 years during the operation, that is a different issue altogether. And that is where we also need to look at the affordability from the ULB side, how affordable the tipping fee that is coming up to is for the ULB. If the gap is too much, the tipping fee estimated is becoming too high, so we have to bring it to a certain level. And as I said, giving support for the capex in the form of VGF then comes into the picture. We'll go in the next slide how the VGF is brought into the picture to reduce the tipping fee. But this is the broad concept of how a financial viability is done. And let's look at each of those heads. So in terms of your cost head, before we start discussing what kind of tipping fee the city may attract, before understanding, we must assess what kind of costs are associated for your city. Simply taking a reference from other city, like say per TPD cost in a particular city is say 1600. So in my city it should be the same. That may not hold true. Why? Because and the counter can be, well, we are comparing the unit rate. We are only comparing the per TPD cost. Then why not? You see, every city has their own dynamics. As I said in the previous slide, that those four stages: collection, transportation, processing, and disposal. If you look at those four stages in terms of cost head, every city will have a different kind of feature, different road network, a different population. So while that can be a good benchmark, I would say, just for the comparison purpose, but every city should do their own assessment, financial assessment, and arrive at the tipping fee, and that will set a good example and base also when they go for transaction. So to arrive at the capex, typically the land cost, civil work, plant, machinery, vehicle, land, in almost all the cases, land is provided free by the authority. It is authority's responsibility to identify the land and provide to the private sector free from all encumbrances. Typically, land is given on long-term lease, wherein the civil cost, plant, machinery, vehicle, these things can be inbuilt in your model. So the fundamental question here to ask whether your land is available and whether it is in possession of the authority or not. Then the OPEX, which is primarily your manpower cost, fuel, utility, consumable, maintenance. In terms of when you look at PPP, when the private sector is coming investing, you should also look at the life cycle cost part, wherein there can be intermittent investment may be required from time to time. So once the project is executed in initial 1 or 2 years, maybe after 5 years, some major overhaul is required. Or let's say the scientific landfill project. In initial 2 years, you have constructed all the cells. But there is something called capping. Capping happens cell-wise, and there is a significant investment at every 5 years, 10 years. So those are the investment that also needs to be built in at cost as cost factor in your model. Then the financing part, which is the interest on debt, your working capital, reserve account, what is your drawdown, how many years the loan has been planned for. These are all cost element. And when you talk about the capital cost, typically when we mention in the feasibility study, it only looks at the component one that you see here, capex. We typically ignore the landed project cost. When we say landed project cost, it is not just your capex, like civil cost, plant, machinery, vehicle, etc., but it is also IDC, which is interest during construction, which can be significant. If the project is getting executed over a period of 2 years or 3 years, so during your construction period, whatever interest is accumulated, that is significant. Plus, there are insurance charges, there are financing charges. Put together everything, that is called landed project cost. So the private party will look at this landed project cost as the base cost for them. So there can be some difference between your cost estimate from your technical report versus when you prepare the financial viability financial model. You should always take the landed project cost. And for the OPEX, of course, there can be certain fixed cost that you have to incur regardless of the size of the project. So, say SLF at a very small SLF versus a very large SLF, there can be certain manpower costs that will remain fixed for both the project. So there can be certain fixed costs, there can be certain costs which are linked with your quantity. So suppose the city generates 100 TPD, maybe per TPD so much of cost is associated. So that kind of cost, which is variable with respect to the quantity of the waste, can be gradually increased, but there are certain fixed components. So OPEX should also be looked at in both segments, the fixed versus the variable cost. And then in terms of revenue, there are the different kind of possibility of revenues, and all revenues are not same. Tipping fees, in case of your composting or MRF, landfill, this is a very common term. The authority pays tipping fee. It typically measures rupees per ton handled or processed. We need to be very clear when we are calculating the tipping fee. Is it for year one? Is it being indexed appropriately with the inflation? How the payment security has been ensured, and what is the history, first of all, of the authority or the client to pay the tipping fee? What is the buffer? 3 months or 4 months when the first payment triggers. And why that is important is because if your first payment comes 4 months down the line, then the private operator will have to keep so much of working capital in hand, and that needs to be built in the model. Another the revenue option is the electricity tariff, which is in case of waste to energy, typically paid per unit, and this is discovered through a competitive bidding process. Here, the power purchase agreement and the concession agreement both governs the overall term of the contract for the private party. User fee, as I said in the previous slide, it is not prevalent in India. This is typically the authority does it. And byproduct sale, through recyclable compost or the RDF. RDF, I don't think the private developer can extract revenue out of it. It's a kind of burden for them. They ultimately need to dispose it to any nearby cement plant, and it is an expenditure for them. While arriving at the financial model, typically what happens, the transaction advisors who are working with the city, we also do that. I mean, when we are working with the government, we consider this sale from byproduct as one of the revenue stream, and we try to calculate the overall cash flow. But the whole idea is not to say that this is a becoming a revenue source for you. I mean, this is a extra revenue that the private party can generate. The dependency should be on the the main payment model, which is either tipping fee or the electricity tariff. Whatever over and above that the private sector can generate, I think we should leave it to him, and that will give you a better model. Now coming to how typically a financial model is prepared. We start with certain assumptions, and like they say in your Excel, your output will be as good as your input. So your assumptions are basically where you are providing all the input, and then comes your capital expenditure, the OPEX, the revenue sheet, then your taxation, financing goes to cash flow, and that is how your return is calculated. The whole idea of preparing the financial model is that it's a mathematical model basically, wherein by making one simple change, you should be able to see the result at the end. And and that is how if the model switches from one person to another, he should not find it difficult to understand the model and where exactly he should try to make certain changes and see what kind of sensitivity or what kind of result the model is providing. It is the assumption sheet where you have to mention everything, whether it is the waste quality, quantity, the construction period, inflation, everything. And then from there the next sheet, whether it is capex, opex, revenue, everything can be linked and calculated. So one change in assumption sheet will give you the final result. Also, yeah, so I think it is not just you must have heard these terminology. What we will also try to do is not just show you how a financial model is the components of financial models are, but I'll try to give you a flavor of a working model after a couple of slides. So maybe you will be able to appreciate what I'm talking about. Once your model is prepared, then there are basic couple of indicators that you must look at to identify how well prepared your project is, or whether your project is good enough for a PPP. First is the project IRR, which is basically the return on the total project investment before financing. It basically tells you whether the project is able to stand on its own, the costing and from the revenue point of view. Equity IRR is from the promoter side who have actually put in their money in. Because what happens in any project, suppose 100 rupees, 100 is the project cost. The private developer is not going to put all 100 from his pocket. He is going to leverage from the market. So he is going to put only 30 rupees, and 70 rupees he is going to leverage from the market, or maybe 80, depending on the sector, depending on his credibility. He will be able to leverage. So he is going to raise only 20 or 30 rupees out of 100, which is his equity, right? And the remaining will be debt. So the equity return, what is going from his pocket is basically that 30. He will try to assess how the project is going to give, how much return the project is going to give him. And that is the equity IRR, which he is, concerned about primarily. So this is one indicator that we must look at. DSCR is debt service coverage ratio, is basically when he's availing out of that 100, 70 he is availing from the market, he is raising from the lenders. He should be able to pay that, right? So the project should be able to generate enough revenue to first meet the OPEX on a regular basis, keep aside some reserve fund, and after that should be able to service the debt also. And DSCR basically reflects the ability to pay the debt, and typically it should be 1.2, 1.25. Then it is assessed that the project is good enough. And in simple terms, you can also understand it like you have taken a loan. For example, you have bought a house and you have taken a loan, and say 1 lakh is the EMI that is coming. Naturally, your income should be in such a way that you should be able to pay that 1 lakh of EMI, plus certain reserve for your household expenditure or the other expenses that you have, and then you should live. You should be able to live comfortably without any tension. So it is exactly the same way. You should have little bit more buffer to be able to take care of the project expenses, plus be able to service the debt. So this ratio reflects that. And then comes the viability gap funding requirement. As I mentioned in the earlier slide also, the tipping fee sometimes can go up very high. And to mitigate that, we introduce the concept of viability gap funding to make it viable for private sector also, and also for the make the tipping fee affordable for the ULB as well, so that going forward every year the ULB should not be burdened so much. And that is how a VGF component is introduced. And next is payback period. Payback period is typically, how you define your contract period, whether your contract to be 10 years, 15 years, 20 years, 25 years. How do you design that? Which will basically be dependent on the life of the asset, the total investment, how much time it is taking for the private party to recover the investment. So there are a number of parameters which will define your overall contract period, or say the payback period. So these are certain terms, as the financial indicator, or the key output that one should look for to see how robust your model is. And then once we have multiple parameter, we also need to have some sensitivity analysis in terms of if you vary a particular parameter, how those financial indicator vary. So suppose a private party is investing so much of money from his pocket, naturally he would want to have some kind of assurance from the authority, right? That you have promised that the city generates 300 TPD, whereas once he has invested and he starts operating and he sees that it is not 300 but it is much less, then the entire calculation will go wrong. So he to mitigate his risk, he would want to have some kind of uh, mm, assessment, the variation in waste quantity, how much it could vary, and if that kind of variation happens, how his overall revenue is going to get impacted. So he would also like to do this sensitivity analysis with respect to waste quantity. Similarly for quality, now quality is a subjective term. So how can you how can you have the sensitivity analysis? But when I say quality, especially in the context of say waste to energy plant, wherein your the calorific value is completely dependent on the quality of waste that you are supplying to the private operator. So how do you take this also into account? So it's basically when you do the waste characterization in the beginning, when you're doing the technical feasibility study, there itself you can define whether you are providing the segregated waste, whether you are going to provide completely dry waste, and you can also substantiate your waste quality data that you are going to provide to the private sector, and also the calorific value with respect to that quality. And that is how you mitigate the risk for the private developer. And it is not just mentioning in your report. All these things has to go in the concession agreement, which becomes binding for both the party. So when you do the sensitivity analysis, you cannot do sensitivity keeping all the variables, together. So there are 6, 7 different parameters. If you start doing that, it is very difficult to assess, how the situation is arising if you vary all these parameters together. So the best idea here is that one by one, you try to mitigate the risk and keep eliminating them. So once you have, say, let's talk about waste quality. Once you have sorted that out, that component, you don't have to do the sensitivity because that is already committed. The client authority commits that they will be providing such kind of quality to the operator, and there can be some penalty if the authority defaults. So that parameter is taken off. Similarly, you can take out different kind of parameter that are playing a role in sensitivity, and then you can play sensitive with respect to 1 or 2 parameters that will help you and also the private sector to assess how variation in a particular parameter changes the overall project dynamics for me. Now, before we come to the risk part, I have talked about the financial model. So let me just show you a demo of so you understand how a financial model and for the benefit of the large audience. So I have a couple of models with me for, say, the integrated waste management or for scientific landfill. Let me just take you through just one example of an integrated waste management. And during the session, I'm not expecting anyone to completely, thoroughly understand the model. It may not be everyone's expertise also. But I just want you to have a flavor of, whatever we discussed in those slides, in paragraphs and all those terminologies, how it fits into, a calculation in numbers, and any businessman, how he would like to look at different issues and make a decision whether he wants to bid for the project or not, whether he wants to get into. Fundamentally, as a businessman, if you have a sum of, if you have a lot of money, for example, and if you want to invest, how do you make a decision? Where do you want to put in that money? You have choices like, you can simply put it in fixed deposit in the bank, right? Without any risk, you will be getting whatever 6-7% of the return. Let's keep the tax aside. So fixed deposit will give you 6-7% of return. What are the other choices? Then you can look at the market. So if you go for stock market, the risky portfolio can give you maybe 17-18%, 20%. But then you are very concerned, you don't want to take so much of risk. So you will look for something that, something that is not too risky, because market is very fluctuating. So you will look for something that is safe. So then what will you do? You will go for some debt fund, maybe. Debt fund is linked to market, but at the same time, pretty much secured, or maybe mutual fund. So the return will be little bit lower, maybe 10, 11%, 12%. So that is how you make a decision, right? So any businessman, any private party will also do the same thing. Whether he wants to invest in your project or not, it's simply by he has some money, whether he would like to put in on your project or he would put in the same money, this money into the stock market with the acceptable risk that he wants to take. So in the market, suppose, it's a basically opportunity cost that he sees with his investment. So if the market is going to give him, 14-15%, so naturally, if he has to make a decision and if he has to stuck with your city for a period of 15-20 years, naturally, he would want to have a better return. So he would expect, 16% to 18% return. provided the other aspect like, risk segregation and payment mechanism and everything is streamlined. So that is how he would look at the model and he will prepare this. So, fine. So what typically we do when we prepare a financial model, this is basically the total concession period here in case this example is for 15 years. And this is the assumption sheet. As I said, the assumption sheet will mention all the assumptions that you are making here. So when this construction starts, ends, how many months of operation, month of construction, you mention everything. The macroeconomic assumptions, including inflation with respect to the cost with O&M and for revenue. Then comes your waste quantity. And this is only one example, not necessarily that you have to follow the same structure. The structure can be different, but the whole idea is to capture everything. How your waste quantity increases over a period of time. So there can be yearly increase. And here these shows the number of years. And your waste quantity increase is mentioned here. Then comes your capital cost, how your capital cost assessment. And this capital cost will come from your, when I said in the overall project development process, if you recall, the technical feasibility assessment, the technical feasibility report, when you prepare, so this cost estimate can be taken from there. And that is how, different parts will fit together. Now you will see, you have prepared the feasibility report. From there, you take the project cost, the O&M cost, O&M assumptions. And as I said, the accuracy of your calculation, how robust your calculation is in terms of arriving at the cost, will determine how good your model is. And then the revenue from sale of recyclable, as I said, these can be additional source of revenue for the private developer, but the primary source has to be the tipping fee or the tariff. Then your financing assumptions like, debt equity, whether it is 60-40, 70-30. So as I said, the developer is not going to put in all the money from his pocket. He is going to take debt from the market, and then the remaining will go as equity. The VGF component from the authority, whether it is, this is a variable that I will show you how the sensitivity is done. You can change it 10%, 20%, 30%, how it varies, and you can see the result. And then there are, debt funding drawdown, depending on how much time the project takes for the implementation. Suppose the project is getting implemented within 1 year. If you have to do construction in 1 year, naturally the drawdown, you need the money entire, all the money in 1 year. If the construction is happening in 2 years, 3 years, then probably the drawdown will be 2 years or 3 years. And then how much time you will be, the terms of the debt, you will be paying the debt over a period of 10 years. What is the interest rate? So in this model, it is reflecting 12. Nowadays, I think even 10%, 9% also some of the developers are able to leverage. So it depends on both the current market situation, current lending rate, and also the ability of the private developer to leverage these funding. If for a couple of years, if the developer is not able to manage the cash flow, if his expenses are becoming more than the revenue, then he needs some working capital also, and he may need, the working capital borrowing also. Typically, working capital borrowing interest is little bit more. Then certain accounting assumptions, which is, for the purpose of depreciation and tax, it goes into the model. This complete thing, this is how your assumption sheet may look like. Then comes the project cost. Now you would say, we have already arrived at the project cost. Why are we doing that again? So what we looked at the project cost in the assumption sheet, which comes from your technical feasibility report. This only take, accounts for your components, different components, and nothing else. what we are trying to do now is on a year basis, we are going to look at how the implementation is going to happen. And we are going to add the IDC, which is interest during construction, insurance, and financing charges. In my earlier slides, if you recall, I mentioned about landed project cost. So we should always look at the landed project cost. That is the cost for the private party. Now, here, since the project is getting implemented only in 1 year, so we are not seeing that impact. But let me just change, just to show you example. Here, the project is getting implemented in 1 year, right? 12 months, and 100% is getting implemented. What if I say the 60% is getting implemented in year 1 and 40% is getting implemented in year 2? And first year, 12 months of construction, second year, say 6 months of construction. This change here should reflect, how my project cost sheet looks like. Here, if you see, for these 2 years now, the capital cost has been divided into the same percent, 60 and 40, as per my construction schedule. And with respect to that, the inflation is already taken into account, because you see, every year there is a 5% of inflation that we have assumed. So when you are constructing 40% in the next year, that cost would have been escalated. So naturally, you have to simply, you cannot divide into 60-40. You have to take into account the escalation factor also for the next year. And this makes it becomes more prominent if your construction goes for 2 years, 3 years. So then it will spread over 3 years. So what I'm doing is, one change in my assumption is making all the changes here. Similarly, the interest during construction. So just look at it for your information. The total project cost here, it was coming 73 crores in our assumption sheet, right? Now, if you look at the landed project cost from a private developer point of view, it is coming 79, almost 80 crores. So we should always look at this project cost, landed project cost, when we try to prepare a model and we try to arrive at the tipping fee. Then comes how much the VGF. This is ultimately, being pulled up from the assumption sheet. The balance funding, for the commercial funding, and this is the debt and equity. The developer starts leveraging the fund. Out of these 79 crores, now 42 crores will be the debt he will be raising from the lenders, from the bank, and he will be putting 28 crores from his pocket. This is how a project cost then will be prepared, and then goes to revenue, how over a period of 15 years, how how much revenue he'll be getting, how much is the O&M cost for him, then the profit and loss statement, depreciation, and then the cash flow statement. If your cash flow statement is becoming negative, if he is not able to service the debt, you will have to introduce the concept of working capital borrowing. Tax part, you don't have to bother about these things. These are more of a your taxation and your transaction advisory assistance will do these kind of thing for you. But for a broad understanding, how all these sheets put together then gives you a result. So here, the project is giving you the project IRR, and it is giving you the equity IRR. This is how your table would look like. So when I was saying that, how do you take a decision whether you want to put in your money? It is that same return that the private sector is expecting. And this is only for the demo purpose. Naturally, you would not see a situation wherein you are providing 26% of equity IRR, that kind of structuring. So what you do is you do a sensitivity analysis with respect to VGF, how, and with respect to the tipping fee, how your project is sensitive, what kind of return the private operator would be getting. So what is happening here is, this is the sensitivity table, which says that And typically for project IRR approximately 13% and equity IRR of about 17%, 16 to 17% is pretty much acceptable in the market. That is what a private party will also look at. So here what is happening is these are the tipping fee and these are the viability gap funding. If you think that your tipping fee is going very high and it is difficult for ULB to pay that much of tipping fee every year throughout the concession period, then what you try to do, you try to introduce a VGF. So the moment you introduce VGF, the tipping fee reduces. So for example, to arrive at, say the tipping fee was 19 for 13.5%, right? So 1900, 1900 per TPD is very high for the city. So what they will try to do, they will try to introduce a viability gap funding, say 25%. So they will say we are willing to contribute 25% in the beginning itself as project funding. Let's try to see how much it is reducing my tipping fee to. So that tipping fee gets suddenly reduced to 1800 or even lower. So, maybe 1750 or something. That becomes, so this viability gap funding becomes a tool for you to reduce the tipping fee for the city. And this method can be applied not only for integrated waste management, but also for waste to energy or, whatever your project components are. I was just trying to show one example. When you prepare, you can have your own situations, you can have your own different, variables associated. So I think the best way to deal with this is, you start working on this and slowly you will get your questions, and you can always reach out to us or the PMU team, and we are there to support you as far as financial viability assessment is concerned. I wish I could show for couple of other component also, but I think for the benefit of this particular session, I think we will switch to our presentation now. So once the financial assessment, the modeling part is done, it is then the allocation of risk. There can be technological, risk related to land. There can be environmental, social. I think environmental and social is something that, the PMU team has been constantly working with cities and making sure that the land is in possession and there are no environmental and social related issues. So beyond that, I think it is up to the city when they go into the maturation phase related to the technical aspect, waste quantity, quality, the technology selection, the tariff or the collection related risk, the compliance we have already talked about. Once all these risks have been identified, then I think you start allocating who is the best suited party to take care of that. And this is the indicative, a table of how different kind of risk is allocated to different party. For example, land, always authority takes the responsibility to identify the land and provides the encumbrance-free land to the private operator. Waste quantity, sometimes shared, sometimes taken care of by authority. Quality also primarily lies with authority, sometimes with the private operator also. If they are collecting themselves, then they need to ensure and also through IEC activity encourage people to segregate. So what kind of quality of waste they are getting, especially cities who have proposed CBG component. I think this is going to be very, very critical because CBG plant would require certain quality of waste, otherwise the plant doesn't become functional. So here they need to work much before they go for such transaction in order to achieve at least 85% of the segregation. The technology and the performance, construction and environmental compliance are typically taken care of by the concessionaire. They ultimately implement the project. They do the operation and they meet the environmental compliances. Offtake risk is basically the in case of waste to energy, which the power evacuation body, they take care of the response this particular component. So this is how the once you have identified the risk, once you have done the financial assessment, these are the broad blocks of project structuring, which is you define the implementation model, whether it is DBO, DBOT, what is going to be the developer scope, how much is the the concession period, 20 years, 25 years, what is the period wherein he's able to generate his return, the payment terms, risk and mitigation, the financing terms, and keeping all these things in view, then you arrive at a bid parameter, that single parameter on the basis of which you are going to select the private developer. It cannot be two different parameters. So if there are VGF, if there are tipping fee, you need to have one parameter. So what you do is you fix the VGF and you evaluate on the basis of tipping fee, or you fix the tipping fee and evaluate on the basis of VGF. That's also possible. However, it's quite rare. VGF is typically fixed on the basis of your calculation, and bidding is typically done on tipping fee. One example of this project structure for integrated waste management, I would say implementation model can be DBFOT, where the design, build, financing, operation, all responsibility lies with the developer. It can be collection, transportation, processing, and disposal put together as one package, or you can have a separate this thing also. Maybe the disposal is taken out, the collection, transportation, and processing is the scope. But this particular case study is for integrated waste management, where everything is scope of private developer. Concession period, say 15 to 20 years. The payment terms can be tipping fee, so that the private operator is able to generate 18% of return. The financing terms, again, you can define in the tender document itself how much VGF you are providing. If without VGF he is able to generate on the basis of tipping fee, and the tipping fee is affordable to the ULB, you can go ahead without VGF. Otherwise, you can introduce a VGF component. So the bid parameter here can be what is the whoever quotes the lowest tipping fee. And just to depict how the overall arrangement looks like, the institutional arrangement in a PPP model is basically there is a long-term concession agreement between the authority and the project SPV. Here, when I say, again, sometimes the terminology can become very confusing. So when you say project, the special purpose vehicle, it is a dedicated company set up only for that particular project. It is sometimes essential to create a different company rather than operating it from the parent company of the private developer. And for the benefit of larger audience, when we say special purpose vehicle, I mean, with my experience, in those earlier days when I was working on in one of the southern state, and PPP was quite new that time. Believe me, they said we need a special purpose vehicle, and the file was sent to the transport department. So the terminology, I mean, in PPP context, it is very common, and today we are very frequently using this term SPV, but just for the larger audience, I mean, this SPV is a dedicated company for this particular project operation. It has nothing to do with transport or vehicle, by the way. So this is the typical arrangement, how it looks like. And similar example, waste to energy, the implementation model on DBOT, concession period here would be much larger, 25 to 30 years to be able to recover the investment. Power tariff is the main payment terms here, and waste quantity, quality, both are assured by the authority. And bid parameter can be either tipping fee or it can be tariff. Typically, it is tariff. And waste to energy plants are not typically viable on its own. So viability gap funding is definitely embedded. The institutional structure here, again, the waste, land and waste is committed by the authority, tipping fee or the VGF or the tariff is given by the authority. The leverages the fund from the lenders. DISCOM procures the electricity. The SPV takes care of the project facilities, implementation, and construction and operation. As far as standalone SLF is concerned, it becomes a little difficult to structure that on BOT because there is hardly any case that we see in India standalone SLF that has been successful on a PPP basis. There are a number of issues. So one possibility is there, but when you go for transaction, we don't see that kind of market response. If you look at standalone SLF, it can be put together for integrated. If SLF is one of the component, then it is fine. But if you want to have a transaction only for SLF, it becomes a little difficult. So a DBO can be, design, build, operate can be another alternate model where dedicated, standalone SLF can be tried. DBO model is basically wherein the capex is borne by authority only, but the total the contract is given to the private party for the construction plus 12-15 years of operation. So the private party will take care of the construction and operation, but the capital cost is reimbursed by the authority, and there is no financing, financial risk for the private operator here, and that is how these projects become possible. Similarly, MRF and composting can also be there. I think many of the cities have suggested this component. So I think we are already, running out of time. But I leave the floor open for some questions now.
Yes.
Over to you, Kuldeep.
Thank you so much, sir. Thank you for delivering such a insightful session, sir. There are many questions in the Q&A and also in the chat. So we will take some questions with time permit. Then I will allow request Saurabh sir to come and give his closing remarks. So, sir, so this one question on VGF, sir. How VGF in making financially weak but socially important projects viable?
Yeah. So so this is interesting because most of urban project falls into the same category, like water supply, wastewater, these projects. So wastewater project, for example, it is very important to bring in private efficiency. It is not becoming viable. So what happens is that there are different blended finance model that has come into the picture, like hybrid annuity, for example. So what the private party is concerned about, he is concerned about his returns, right? And the government wants to implement the project because it is for the social benefit. So what they try to do is they divide the investment section in such a way that the government invests 60%, the remaining 40% has to be invested by the private party, and some kind of the payment for the private party is ensured. So in the form of annuity, so it is not dependent on some kind of user fee like road sector or something where they are directly getting the money from toll. Here, once you ensure their fee, I think private sector then it is he is comfortable to invest on the project, and for government also it benefits. However, if it is too much skewed, that it is not at all viable and too much of funding is required, probably best way to go for is the operational contract wherein the government invest and the operation is given to the private party. So at least you ensure the operational efficiency. And believe me, once the Urban Challenge Fund kind of initiative has been taken, I think the whole idea is to take that approach wherein the project that were not viable earlier, even those projects, we should be able to execute. So more funding support or the capital support is going from the government side now, so that the projects that we were not able to take up earlier, now that is also becoming possible. So that could be one way to take it up.
Can you please close this presentation, sir, from your side, sir? Only the presentation, sir. Yeah.
Yes, maybe the screen can be unshared so that
Yeah.
all of us can be visible.
Stop share, sir. Your
Yes.
yeah, wonderful, sir.
I
Thank
would
you.
also like to mention, sir, that there are very interesting questions, and the session has been very intriguing because we can see a lot of questions into the chat as well. So I will also bring one of the questions here. So one of the questions mentions that when solid waste management processing yields either 1/5 for composting, 1/3 from biogas, bio-CNG, or even from dry waste MRF, 1/2, basically part. How can it be bankable?
Sorry, come again, please. What is the share that you're talking about?
So suppose if solid waste management processing is yielding through 1/5 of the composting, 1/3 from the biogas, or even dry waste MRF, 1/2 or 1/3 coming from other recyclable options. So the question is, how can it be bankable when there are multiple processing scenarios are there? So this is one of the questions.
No, so we saw that, right, in an integrated waste management where you can have your composting also, MRF also, and collection and transportation also. So there are costs associated with these different components, and when you try to calculate the overall revenue or the tipping fee for the private developer, you take all the cost into account and then accordingly calculate it. So you don't have to look at specifically say MRF or specifically compost. That will be a separate model altogether. So it depends on your packaging, how you are packaging it. Maybe I'm not able to understand the question well, so I would request whoever has raised this particular question, maybe they can reach out to me and have a detailed discussion on this.
Let us take the next.
Yes. Sir, another question is from Sharad Babu. So he's asking two questions in a single question, sir. The drawing, he's asking from your experience, sir, how mature on PPP models in the municipal solid waste sector, particularly in creating viable revenue and return structures, which could be relevant in designing projects that deliver both climate adaptation and mitigation benefits.
Yeah, so I think the climate angle is something that is now embedded in all our projects, right? We are always talking about climate resilient component. The CITIIS program itself is initiated, started with circular, with the concept of circular economy and reducing GHG emission. That is how the entire mission emerged. So when you actually whether it is recycling, or segregation, or to what extent you are able to mitigate the GHG emissions. So for the fundamentally proposing the components such as CBG, that itself is moving in that direction. And as far as creating a bankable or viability is concerned, that is basically a number game. When we talk about arriving at a tipping fee, it is not, you cannot compare it with road sector or, wherein the private developer gets the revenue from toll, which is a completely user fee based. Here we are talking about tipping fee. Tipping fee, in a way, it is nothing but a kind of, assured fee. It is not dependent on any user fee. So the only thing we are checking is whether the tipping fee that you are arriving at, it is affordable to the ULB or not. But if you look at it from the developer point of view, it is some kind of guaranteed fee only. It is not fluctuating. For example, in highways or toll, you don't know how many vehicles will come, how much toll you will be able to get. Here, once the tipping fee is freezed, this much quantity is there, you will be able to get so much of money. So I think that is another way to look at it.
Yes, sir. Thank you so much, sir. And another question is from Apurva Sahu. So he's asking, what is the ideal bidding parameter for PPP transaction in MSW? Should it be tipping fee, electricity price, or something else? So he's wanting that how this bidding parameter can be linked to KPIs, basically.
No, so these are two different things. So bidding parameter, as I said, depending on what your project package is. Typically, if you are going for waste to energy by incineration base, suppose you are producing electricity, naturally the bidding parameter could be the tariff that you quote. So tariff, suppose the bidder is quoting, he is calculating and his tariff is coming 12 rupees per unit. Naturally, you will not be able to pay 12 rupees. Who is going to buy for 12 rupees? Because your current rate example is 7 rupees. So what you will do, you will fix it at 7 rupee approximately. You would want the private developer to quote somewhere around 7 rupee and you will introduce VGF. So bid parameter for you here in this case would be the tariff, provided there is a provision of VGF. So it depending on what is your project, the bid parameter can be fixed. Suppose you are going for composting plant. Naturally, the bid parameter cannot be tariff here. It can be tipping fee. So it depends component to component. Once you prepare the feasibility, you will get to know that.
Right, sir. Thank you so much, sir. Another question is from again Apurva Sahu. Sir, what is the ideal assumption for concession period?
So again,
So
it depends. Again, it depends, project to project. So if it is only, as I said, the larger the investment, typically, the larger the concession period. And waste to energy will have 25 to 30 years typically. The integrated waste management can have 15 years because your vehicle will also has a life of 5 to 6 years. So there is a replacement required. So you take these factors in view and decide what is going to be your concession period.
Handle work. So PPP may be suitable for government departments and ULBs with limited manpower and technical expertise. However, smart city SPBs are limited companies and are expected to become self-sustainable and revenue generating. In PPP projects, private partners often invest using government or ULB land, retain a major share of profit, and provide only a nominal revenue share, often for 15-30 years. Can a smart city SPB instead adopt an on-investment model funded through bank loans or loan support from the ULB state government so that the investment can be repaid from the project revenues and the SPB can retain the major share of revenue and the profits?
So I think three things here. Number one, so fundamentally, we discussed in the first slide itself, in our session that there is a funding gap. ULBs don't have that kind of money to invest in the project. Number one. So as in, whenever that stage comes, right now, ULBs don't have that kind of money. Second, the expertise. So the government cannot have expertise in everything, right? So as far as you may have money to invest, but as far as operation is concerned, ultimately you will identify an operator. So right now you don't have money to invest. You don't have operation, competence. So that is why you are looking for a private sector right now. And third is, as far as revenue share is concerned, I think we should move out of this mindset that we should get some revenue out of it. Even if I have seen cases like if somebody is developing a compost plant or something, and we start looking at private sector's revenue from sale of compost, so we start expecting that we should be getting some revenue share out of it. I think the sector is not it is not that mature wherein you are producing a product which is giving that kind of revenue. So first of all, the city has to rather pay here rather than expecting a revenue from the private operator. It is other way around. So whatever revenue the private party is able to generate through compost or recyclable, I think that is some additional benefit to him. But it is a sector where he's not producing a products where we can expect a revenue share. So I think in future, whenever you have, the cities have that kind of ability, that kind of funding, maybe the city can invest in the implementation. But still, I think for the operation, they would require, a competent party.
Thank you so much, sir. There is another interesting question on PPP, which is how can small cities make project financially viable under PPP model. So PPP can be implemented in big projects for big cities, but how small cities can benefit out of it? Do they go with the cluster approach, or how they should plan it through the
No, so I think I think the question has been asked in a broader context, not just solid waste management. Solid waste management, I think we have already discussed what kind of packaging different components can be there, but smart city in general, they should start looking at commercializing their land parcel or the establishments, and prepare the project in such a way so that the private sector can also get some value out of it, and start looking at any project from this project development cycle point of view. And Urban Challenge Fund is doing exactly the same thing when they have requested from the cities for proposals. Every city needs to come out with only those kind of project that can be self-sustainable. So that is one opportunity, and I would request all the smart city to then send their other than solid waste management projects to Urban Challenge Fund.
Sir, thank you so much, sir. Another question, we will take only 1-2 questions, sir. So another question is, are there any successful example where the lending cost project lending cost has been recovered, sir, in the solid waste management field?
Sorry, Kuldeep, can you come again? I lost you in between.
The question is that, are there any example where the project lending cost is successfully recovered, sir?
So
in the MS
so any PPP any PPP project that is happening where private sector has invested and getting a tipping fee, he has naturally recovered his investment, otherwise he would not be there, the project would have defaulted.
All right. Sir, there is one remark on carbon credits, sir. Whether carbon credits can be looped in for the revenue purpose. I think that is the question. So
Yes, it can be, and typically this is captured quite in detail when you enter into a concession agreement with the private developer, like who would be able to take the benefit, whether authority or the concessionaire, or in what share. So it will be divided 50-50, or who will take the credit. That is pretty much captured in the concession agreement.
Okay, sir. Thank you so much, sir. So we will end our Q&A session here, and we will request our participant to email the question to us. So if you are not get your answers, I will forward the questions to you, sir. And I will now request Saurabh sir to deliver closing remarks. Sir, over to you.
Thanks, Kuldeep.
Thank you, Jailendra ji, for such an insightful session. I know we have limited time. We are already crossing our time limits, and there are a lot of questions, a lot of insights that you gave today will really help us, particularly where we are, where almost 15 of our cities have already chalked down and prepared their concepts on the proposals. And many of these cities also came up with PPP projects, particularly on CBG, and they're preparing their feasibility report. Some of them are preparing the feasibility report. I truly understand that all the team, all of you who have joined today, this webinar, thank you for your time. I hope this webinar would have given you a lot of insights on the financial viability that needs to be taken care when we talk about projects. Particularly when we are talking about viability of those projects in our cities, we come up with from different areas, different cities, different challenges. The revenue which could have been in one city might not be there in second city as well. There could be some demand in a particular region, which could help as well. So all these projects needs to be looked at very carefully to make them sustainable. I must thank Jailendra to take us through a rigorous Excel based exercise also, which showed us that how project revenues or revenue stream is helping us to make it more sustainable. Lastly, I would thank Kuldeep, Ankur, and the whole CITIIS team over here for having us together for this webinar. Certainly, this webinar will be made available live on our website. After this, the recording gets uploaded on NIUA's YouTube channel and thereafter on CITIIS website. Thank you again. Thank you, everyone. Looking forward to see you again in the next webinar soon. Thank you.
Thank you, everyone.
Thank you so much, sir. Thank you, sir.
Thank you.
Thank you.